Good morning, everyone. This is Mortgage Pros 411, and today I am joined by Nadia Evangelou. She is a principal economist with the National Association of Realtors. Welcome, Nadia.
Thank you, Audrey. It's such a pleasure to be here with you today.
I'm so happy you're here.
Yeah.
I'm really sad Kevin is not here today. You will notice there is a missing link here. Unfortunately, he had a death in his family and had to trot off to the UK, and so he is unable to join us. So anyway, so sorry for his family and looking forward to him coming back. Not next week, though, because he has something else going on. With all that being said, it's quite the happenings in the economy and the mortgage world these days, as always. So, just for fun, tomorrow we have the Fed minutes are being released and the housing data. We have housing data coming out. Thursday we'll have starts and permits, and then Friday, do not forget, the markets are closing early for the holiday because, in case you haven't looked at a calendar, it's Memorial Day weekend, and we will be off on Monday. Can you believe that? It's already Memorial Day. What is happening? Okay. In other news, if you are in the Thousand Oaks, California area, Greater Ventura Camp is putting on their 12th annual Lender Fair on Thursday from 12 to 4. It is always great. I'm always there. We're always there. They are so kind to invite us, and they're going to do a panel on insurance and also on mortgages. So bring your scenarios, ask questions, find out ways to close loans. It is really important that we get out of our offices and out into the world. We keep talking about this over and over again. You can't just sit in your office and think that the whole world is going to happen for you. So, Nadia, where to start on this Tuesday morning when there is so much happening, so much we don't even want to talk about. So, um,
Indeed.
we have been
Many
we
happening.
we have been mentioning weekly oil, rates. It has been a bloodbath last week. I mean, just crazy, crazy in the bond market and oil prices, and the inflation numbers came out. PPI came out last week. It was a barn burner. I mean, oy vey. So headline
We
was up.
expected a little bit. It's not by surprise. We expected a little bit like to have
It
these higher readings, but yes,
it was
still
three
mortgage
times.
rates. Yeah, mortgage rates are still like according to Freddie Mac, like 636, like until like we have like the new figure like today, like later, like this week, but still relatively like lower from a year ago. So that helps.
I know. Thank you. Thank you, Sunshine. I really, really appreciate that because the headline was at 1.4%, and the year over year went from 4.3 to 6% on PPI. And again, they always like to point out the wholesale inflation doesn't always trickle down to the consumer, but it's out there and it does impact things. Core was also up. So anyway, we had some rough inflation numbers in the last week and a half, and so anyway, we are all really praying that this turns around sooner rather than later before more damage is done. But to your point, MBA mortgage applications came out. Purchases were up 4% week over week last week, up 7% year over year. That's for purchases. Refis were down 1% week over week, but they're still up 28% year over year. So they're doing all right. The mortgage industry is still doing okay. There certainly are multiple offers. I mean, where we are, we talk about this all the time. Mortgage, there are multiple offers on properties, on every property that my clients are offering on, and Kevin's as well.
Yeah, and we see that actually because sometimes we talk about price reductions or like people like the homes are still like longer. But what we see when you break that by price segment, you see that homes that they stay longer are usually the luxury homes. They're like homes with valued like 1 million and plus. But what you see for lower, like where most buyers can afford to buy, the market, there are still like multiple offers like in these homes because of course there are like many buyers out there that they're like competing for this small number. So they're still not enough for the buyers that are out there. So that's the reason we see, yeah, 1 million and plus, we see like longer days. But for most of the homes that people can afford to buy, you still see like multiple offers. And again, it depends like on the location. So And this is what we see. So now it's not like any national like market. It was not like usually like real estate is very local, but
Right.
now we see like even more because you see like more homes like in the south, in the Midwest. You have like better affordability in the Northeast. You have like tight inventory, so that can explain why home prices like continue to rise in the Northeast compared to other like parts.
Well, we're finding in our area because I mean, for a starter home, you're at $1 million. So
Yeah.
we're seeing that if the house is done, a lot of buyers lack vision. I don't know if you've noticed this, but when they walk in, they're very hyper fixated on things like wall color, and it's hard for them to see past a house that hasn't been fixed up. It doesn't look like it does on, a finished product on HGTV or something like that. So those houses that aren't being fixed up, and in my area, literally a lot of realtors, they want to move the sellers out. They do all the rehab and then they stage it. And it looks like it just fell out of a magazine. And if it's not like that, then good luck. So anyway, it's a weird market for sure, but the I find it interesting that the demand is still there despite everything that is going on in the world and in the economy. And what I like about that is it really speaks to the fact that people need a place to live. I mean, ultimately, we lost sight of that, in my opinion, in the last number of years because everyone wanted, the lowest price on a house, but the lowest rates, which typically doesn't happen at the same time. And, what is the rate? How much equity? All these things. But really, it comes down to you need to live somewhere. Where's that going to be? Does
Indeed.
your family, are their needs being met?
Yeah, I know, I totally agree. And it was like one of my favorite like analysis, like it's that I looked at home equity gains over the last decade and how this translated like into something like people like can actually understand. And what we see is that the years of household income that they were when you compare the home equity with the household income like that they have, we see that the national level is that the typical homeowner gained housing wealth equivalent to about 3 years of household income over the last 10 years. And in some markets like San Jose, like California there, so San Jose, Los Angeles, and Miami, the gains exceeded like 5 years of income. So I think this is really what changes like how people think about home ownership. So of course, housing isn't just like shelter, but for many households, it became one and continues to become like one of the largest sources of wealth creation. So, and even I will say, though price growth is moderating, like currently, homeowners are still likely to continue like building wealth. So this is what we say: they continue to build wealth, even though it cannot be at the same pace. It can be like at more sustainable, like healthier, like pace. But no, when you translate your equity gains into how many years of income, I think it's fascinating to know that yeah, in 10 years you have like the national figure is like about 3 years of income that you were able to accumulate with your house. So yeah, and for investors it's even bigger because usually they ask me, okay, why real estate? Like so if it's still like a good investment. And yes, indeed it's like a good investment for many years now over time because it can do two things at the same time. It can create income through rent and also while building wealth through appreciation. And that's, I think it's very important. Like stocks can provide dividends and growth, but real estate is very difficult because people will always need a place to live, work, do business, or like do shop. So yes, they're gonna need both like residential, commercial, and I think this is what can describe why real estate is still like so important in building wealth.
I think it's interesting when I'm listening to other podcasts, other people talk about what's going on in the industry, and I hear a lot of times the people that are on these programs, they're not loan officers. They're C-suite, their management, their own whatever, right? They're at a different level. They're not interacting directly with the borrowers like we are. And I feel like there is a disconnect for those people because they don't understand how important it is for these borrowers that we focus on them and homeownership and what they can achieve from that. Because I'm seeing them say, oh, well, it's cheaper to rent than it is to buy in, certain areas. And okay, but you're missing the point, which is you're just flushing money down the toilet when you're renting. So what are your thoughts on that?
Indeed, but sometimes it's how you compare. Like the monthly payment. Do you compare it with the media income, or you compare it with the media income for the 3 bedroom? Because usually when you buy a home, it's not like a 1 bedroom like home. So when you compare it with the three bedroom like rent, usually what we see is that more than half of the metro areas they have like the mortgage payment is less than the income than the rent. So yeah, it may make like for 1 bedroom like more sense to rent, but when it's a
Interesting.
family, no, when you compare these figures, it's not like you see that how mortgage payment is like less in many of the areas that you don't expect to see compared to the 3 bedroom like rent. And of course, you don't create any wealth accumulation, you don't create any
Exactly.
equity, and that we can see it from the data. I'm like the net worth of a homeowner is 40 times. It's about like $420,000 of the homeowners, the net worth, compared to just $10,000, which is like for renters. So it's like about like 40 times higher than the net worth of homeowners compared to renters. So that's very important, and I think everybody like knows that. So that's the reason we see the demand out there. It's not that people don't want to buy homes. Of course, they want to buy homes. It's just like affordability. And I think it's the affordability that acts like a speed limit for the housing market. Affordability and supply as well, of course.
The messaging is so important because people hear, oh, you can't afford this, and they believe it. They don't even check. Or let's say they go to their bank and the bank has their little tight credit box and they didn't fit into it. And now they were declined and they walk away thinking, I don't qualify for a mortgage. And they don't understand how many options are out there. That is why we have to be shouting from the rooftops so that everyone can hear that there are options out there for people, even if you don't have down payments, even if you don't have a lot of money, it doesn't preclude you from owning a home. And how do we help you figure that out? Because again, the people who have a lot of money, they don't understand what the rest of the world is living with. And so there again, this disconnect, which I find to be a little frustrating because they have loud voices. They have all the money, they have loud voices, they have a big platform, and people listen. And I have, I was speaking in with this group of women investors recently, and it was very interesting to hear them talk about what they believed were the things that would keep them from owning a place. Even about, I had one woman who thought she was going to be discriminated against when she went to get an appraisal. Well, no statistic says that that is going to happen. And it was really interesting, not to say it doesn't happen. Let me be clear. We all know that, there are situations where there are issues, but we also know that if we're looking at the data from Fannie Mae and Freddie Mac, who've really, really been studying this for years and years, the whole appraisal thing, we know that statistically the number of actual situations where there's discrimination is tiny, tiny. But because there's this big conversation about, or there was a big conversation about it in the media, there's this idea that this is a problem. Well, it goes for everything. Oh, if everything is unaffordable, well, I can't even try, right? They don't even try because they don't think they can. It's
Yeah, and
so
sometimes
heartbreaking.
it is, and I'm sorry for interrupting, but sometimes we say that yeah, now it's like so difficult, and it is. I'm like affordability is very low, but sometimes it was another like research that I did is that I compared, like for example, compared to 20 years ago, like, and what I found is that the District of Columbia is like compared to the income is more affordable now compared to 2005. So
District of
that's
Columbia.
yes, yes. It was fascinating. Of course, there are like many difficult, some like affordability is a very is low. It's the weakest. However, it's better than a year ago. But what we see is that when we compare income with with the payment, we see that yeah, compared to 20 years ago, uh, it's surprising, of course, but we say that the district like is more affordable now than compared there. And the reason for that is because incomes have grown like significantly. So prices have increased, like mortgage rates are like higher, but what we also have seen is that incomes have also like increased like significantly during that time. So that was the reason that offset some of the price increases, for example, and made like relatively like more affordable now than 20 years ago. Yeah, that's very surprising. But when I see something like that, I like to point it out,
Well,
because
okay, so there is one, and I mean one other economist who I have seen point that out. Now, that is not to say that I have listened to every single economist on the face of the earth. So there could very well be more than one other person, but I have heard that from another economist as well, and it goes completely against the grain of what is talked about in the media. So the idea that affordability is not quite what is portrayed out there, and again, I keep pointing out the idea that our lifestyle expectations have
yes,
changed so dramatically that it has less to do often with housing and much more to do with the fact that the average car payment in America is over $700 a month. And if you times that by two, and childcare is through the roof, and right? And everyone thinks they should have a Louis Vuitton purse, and that is just an entitlement. And so when you're spending all this money on other things, you're doing Uber Eats 5 days a week and you don't cook. And anyway, so
yeah.
the point is there are so many things that are making us feel like we're strapped, right? And how do we address that as a whole, not just housing, which is something. Another thing I'm hearing promoted quite a bit out in the podcast world, on LinkedIn, in the media is, what we really need is a big price drop. We really need values just to take a plunge, and that'll fix everything. Please, Nadia, tell us what you think about that.
Yeah, no, I'm not supporting that idea. So because I'm like, when you drop like prices, you may fix like affordability, but you don't fix supply. And right now, the housing market has two main challenges, and it's not only this year; it's had like for many years now. It has affordability, but also supply. When you increase affordability, this means that more buyers will be out there looking for a home. So if you don't increase supply, that will make like prices to grow even faster. So you cannot like fix the issue when you just like increase like affordability. However, when we take a look at mortgage rates, and this is what I want to point out, that mortgage rates are the defining factor over here, because with just 1% point drop from 7%, for example, to 6%, you have the same effect on affordability as a 10% drop in home prices. So I think that's very important because, okay, with lower mortgage rates, you fix affordability, but then you fix supply as well, from the point of view that there are like so many homeowners that are locked in because of the mortgage rates, like lower mortgage that they had. So when they see like a relative like closer, like instead of like 76%, like from 6 to 5%, because what we see is that the break even, like the percent, the rate that will make zero lock-in effect is the 4%. We don't expect to have 4% anytime, like very soon. But when homeowners see a 5% or 5.5%, this can also help like with more homeowners to list their home, and then you increase the supply as well. So it's first of all, you do like mortgage rates don't need to drop like significantly in order to have the same effect as home prices, that they need to fall like, for example, like 10% in order to have the same effect in affordability.
Yeah, and when those guys start babbling about, oh, we just need a big price correction, I remind them it's contagious. If all of a sudden prices start dropping, then people think the sky is falling, and now we're headed to another meltdown, and now they're going to get a good deal, or they're going to bail out of the place they have because it's all, crap anyway. And it is just such a bad idea. And it just blows my mind that people in the mortgage space even talk about this as a good solution for our current problem. And anyway, it drives me crazy. All right. Um, the idea, okay, let's talk about these rates for a second, because I actually, every time somebody starts talking about, oh, we just need, 4% or 3%, I put them in timeout. I'm like, listen, that is ridiculous. because what it would take to get us to that place is a lot of um, monetary involvement. I mean, at the federal level, we'd have to have a lot of quantitative easing, et cetera. And we've seen the impact of that. So they start injecting a lot of liquidity in the market, rates go down, and then it's not good for us ultimately, because then eventually you have other issues. And so um I've been listening MBS Highway, Barry Habib and Dan, they've been talking about the amount of quantitative easing that he's been doing in the last number of months, where they've been buying the short-term treasuries. What were they buying? They've been injecting a lot. They've been buying like 40 billion a month, and I think it's 2 year is what they've been buying. Anyway, the and now they are saying that this is part of our issue right now, is that they've been injecting this liquidity in the market. And now the banks aren't investing in other. Anyway, it's complicated. And I just find it interesting because I feel like they were really excited about this when the Fed announced they were going to start buying, um, injecting this money into the market. So anyway, my point is, if we are going to have much lower rates, there's a lot of hair on that, and it can cause all sorts of other problems that will translate into things being less affordable in other areas. And do we want that? And also, I would just like to constantly remind everyone that the idea of going back to really low rates, we closed a ton of loans in 2020, 21, kind of 2022, and then it was just the abyss for the next 3 years. Okay, so do you really want to have a crazy market where you close a whole lot of business in a short amount of time, and then you have to go on unemployment? Oh, wait, we're a commission only, so we can't do that for the next God knows how long, because the business dries up because everyone thinks that that's normal. So again, 6% to me sounds great. We'll take it, right? Yeah.
Yeah, and sometimes again, when you compare, like we know, like tax refunds are hitting the market, so there are like many people like they have the tax refunds currently, and the 2026 about 3,700, the average tax refund for
Wow, really?
yes, yeah, 3,700, which is like about 11% higher than last year. So that's good that we have like higher tax refund like this year. But when you make the math a little bit, do the math and you see what is the monthly payment with a 6.5% rate versus a 5% rate, it's fascinating to see that it's the extra cost over a year is 3,700. So sometimes, I'm like, you may think about that, like it's opportunity cost. I'm like, if like for
Interesting.
1 year, the 3,700 can pay a loan with a difference between like a 6.5 and a 5% rate. So of course, I don't say that they can do that like for the rest of the year. So they may don't have this tax refund, but this is another like way of thinking how sometimes you may be so close to buy a home, and
Yes.
this can drive like some people that I didn't think about that. So because we are always saying about like mortgage rates to be low, like 5%, but sometimes it's very sometimes the math can work, for example. But yeah, it was fascinating for me to see that that extra cost is almost like the tax refund like this year. So something else like to have in mind.
That is really interesting. Okay, so here's my question. I don't know if you know the answer, because I don't know if the answer is known. Is this because people are just really under or overestimating how much they're going to owe on taxes? Is it because the tax laws changed? Is it why? Do you know why?
It's yeah, it's because of the new bill, but also some of them they paid more. So it's a combination, I will say, both of them. So yes, but yes,
Wow.
3,700. Yes, that's
Wow. I know a lot of people who would rather, some people I know use that refund as a savings account.
yes,
They
and that's
look forward,
amazing.
yeah, they look forward to it every year. And so when you're like, wait, you're letting them use your money every month and you're getting nothing from it, they don't care. They just think, okay, I'm going to have this little, windfall, even though it was mine to begin with. It feels good to them. So,
Yeah.
wow, that is really interesting. Okay, just in other news, Kevin Warsh was sworn in as a Fed governor last week, and he will be sworn in as our new Fed chair on Friday. Um, I I don't know why anyone wants that job right now. I mean, it is just fraught with all sorts of, it's going to be rough. Like it's just not easy. And he's actually said he might raise rates, and it'll be interesting to see how that goes. I think that's a good thing that he's talking about it, because at least the markets will think he's operating independently, which is, in my opinion, important, because they don't want to think that he's just doing what he's told, and then the markets are like, all right, well, that's bad, and then react adversely. So anyway, so that'll be something. Also, I keep receiving these notices from NMLS, and they're scams. So I am going to keep reminding everyone, make sure before you click on anything that you check to see where it came from, because there's masking. So it looks like it came from NMLS, but then when you really, click on the email address, it's from some random place and God knows where. And so they are, it's I just can't believe that they're using NMLS as a as a way to get people, but they are. And then also they're another reminder, just Google yourself every once in a while, because there are people, I don't know who it is. There are people out there, and they are taking the identities of LOs, and they are doing all sorts of nefarious things like closing loans in our name and doing God knows what. So make sure you're aware of what is out there in your social media presence and on the web in general. So, Nadia, you prepared a report for the National Association of Realtors about capital gains, and it was
Mhm.
called The Growing Gap Between Home Prices and Capital Gain Limits. And this is something that is near and dear to my heart. So will you please walk us through what you found and your takeaway from your research?
Sure. So we talked a little earlier before about mortgage rates as a key like friction like in the market, both on demand and supply side. But mortgage rates, what we see is are not the only factor affecting homeowner mobility today. So there's another one, less visible but increasingly important like constraint. That's the capital gains like exposure. And I want to say that okay, new construction is absolutely critical for supply. It's how we expand housing stock over the long run. But in the near term, like the market depends heavily on turnover. So about 85% of home sales involve like just existing homes. So if we want to understand why supply is still constrained today, we have to look at what's happening with existing homeowners and what is impacting like their decision to move. And this is where capital gains like comes in. So the capital gains tax inclusion, $250,000 for single filers and $500,000 for married filers, where was set in back in 1997 and has not changed since then. But the housing market has changed dramatically like since then. So home prices have more than tripled nationally, and at the same time, when you adjust the exclusion for inflation, it's the real purchasing like power has cut like roughly like in half. So we talk about like the 500,000 like that was like in 1997. Now it's about like less than $250,000. So effectively, the policy has become like much less generous over time, even as home values have increased like significantly. And what that means is that a growing number of homeowners now have unrealized like gains that exceed those thresholds. So when they consider selling, they're not just like thinking about where to move or what they can afford. They're also thinking about the potential like tax liability and how much of their equity they will like actually keep. And that creates, I would say, another layer of friction in the decision to move. So if mortgage rates are one reason like homeowners are staying put, capital gains exposure is becoming another. And increasingly, we're seeing like homeowners who are like effectively locked in on both sides. So when we look at the data, we see that about like 13.1 million homeowners, or about like 1 in 7 homeowners already have gains above the current exclusion like
Yeah.
thresholds. But what really matters for the market is where these homeowners are. And there are like two ways to think about this. So in absolute numbers or as a share of homeowners. And what we see in the absolute numbers, the exposure is concentrated like in the largest housing markets as expected. So we have California. California alone accounts for about 3 to 4 million homeowners above the threshold. Then take like Texas and Florida. Each one of these states have well over 1 million exposed homeowners. And large markets like New York and Washington, D.C. metros also have like significant like volumes there. So from a transaction like perspective, this is where capital gains has the biggest like impact on overall housing turnovers because of the scale. But when we look at this as a share of homeowners, because we do that usually just to capture some smaller areas, what we see is that that's where the constraint like becomes like more even binding. So again, you have like high cost metros like San Jose, about 63% of homeowners are above the threshold. So 2 in 3 homeowners are there. So San Diego is about like 54, Honolulu 54. So I'm like, these areas, these markets have like the majority of the homeowners that they are locked in because they have unrealized like capital gains. So then we also have some fast-growing like markets. So for example, we have Boise, about 22% of homeowners are already above the threshold, and then Nashville, for example, about like almost like 20%. So this is what we see like the two dynamics like happening. Like so, you have the coastal markets exposure is very high, and then you have the growth market where because home prices increase like significantly, there you have like some more homeowners, relatively like more homeowners that they have exceeded these gains. So I think we need to have that in mind because sometimes we focus only in just like new supply, like new construction. This is the way to increase long term, but you also want to increase the turnover because that's the way that the market still performs. So like we have about 85% of the sales to be existing homes. So I think something to have in mind about where exactly it is. And usually these are the markets that you have like inventory, tight inventory. So these are the areas that they need even more to have like more mobility and more turnover like there.
So there is a bill that has been proposed. It's called More Homes on the Market Act.
Yes.
And it's proposing that they double the exclusions and then they index to inflation going forward. What are your thoughts on that? Do you know much about that bill and do you think it has any chance of
Yes.
passing?
And as an AR, we are advocating for that. I'm like, we, like our advocacy team is working like very closely because this is something that we want to be included as well in the bill. So we have like this doubling, at least like to go like to 1 million, like for 500. As I mentioned, like the inflation, if they're adjusted to inflation, can we go like to 1 million or like 500? So this can be something that more to reflect more the housing market right now.
So do you have a sense of where that is in the system and what the likelihood is that it might and when? I mean, would it tell it? Do you know anything else?
We are in discussions, I know about
Okay.
that. So yeah, and we're
Okay, so
working
keep us
very
posted on
closely.
that. Yeah, I mean,
Yes.
I think that would, there are a few things in my mind that could make a huge difference immediately, and this is one of them for sure. We have talked a little bit recently about some of the advantages we have in California around property taxes, and the Prop 13 is one of them where we have a limit of 2% a year increase, where we're hearing from around the country that a lot of the places where they've had massive increases in appreciation, they're really struggling with their new property tax bills that are coming. And what I didn't realize is that every state reassesses property values differently. I mean, as far as some do it every year, some do it every 4 years, some do it. And so it's not like it all happened at once in every part of the country where everyone got a big property tax bill. It seems to be just happening over time, and it's an issue. And we also have part of what is good here is that once you're over the age of 55, you can take your tax base with you when you sell your property. So if you have a lower tax base from buying your house originally, or you're buying your place originally, you can take that to your next property. So those are some things that are helpful here. They don't fix things for sure, but the capital gains is, in my mind, the biggest. It's huge, huge, huge.
Yeah, and sometimes they say that there's some arguments that yes, but you don't increase supply because these people will go and buy another one, so you don't really like increase the supply. Like usually when you provide tax incentives to investors, for example, that's a real supply because investors are gonna sell, but they're not gonna buy because it's not the primary residency. But what you want to do in a market, you want to increase the turnover, you want to increase mobility because it's at its lowest almost like it's going down year after year. So you want to increase that because have in mind that every home sale generates income for the local economy. At the national level, it's about like more than $130,000. With each home sale, each home sale generates income about like more than $130,000. So can you imagine like this? We need to have it in mind. Like real estate is about like 18% of the economy. So these can also help like economy to perform like even better. So it's one big part of the economy, and I think sometimes, yeah, when you have like higher mobility rate, you help like homeowners as well to live their life because you don't want to have like homeowners to be stuck at home. They want to move in their life, like maybe new job or like maybe like downsizing. I have like many examples with baby boomers that they want to downsize and they bought like a house like somewhere in New Jersey or like New York about like $200,000 and now it's like 1.2 million. So they don't want to pay these taxes. And so yeah, they have to like live like longer there. So and at the same time they have to pay like maintenance because it's an older home. Again, it's like more things to think about, I think, when people like staying like longer or they stay put there. Yes.
Well, and also a lot of the people who are much older would
Mhm.
like to move somewhere else that is less
Yeah.
expensive, smaller, maybe even into some sort of senior living place that's
Mhm.
more, it's just a better size, and they just can't. I mean, a
Yeah.
lot of people around here are doing the math, and it's more expensive for them to move into a smaller place than to stay put. So, again, to your point, the capital gains thing would really, really help with that. And I think it's something that we all need to be aware of and supporting and make sure that, if there are calls to action from our trade associations, that we answer them so that our politicians are hearing from us that this is important and this is something that their constituents need. So yeah, please keep us
I
up
think
to
we are
date.
yeah, we are preparing a call of action. I think it's gonna be or later this week or next week. So we'll have like a call of action, like a call in action, like for
Oh,
capital gains. Yeah, coming out. Yes.
okay. Well, yeah, let us know and
Yes.
we'll share the link. And yeah, we'll
Perfect.
help with we would love
Yeah.
to help with that. Yeah, it's big. Okay, there was an interesting note in Rob Chrisman's blog, I don't know when, recently, and it was that the median age of a home in the US is 44. And the comment was, it's getting expensive to maintain them. To which I laughed because I've spent a fair enough amount of time in the UK and Europe. And last year I stayed in a 1,000-year-old place. It had been in the family that long, as a matter of fact. Why are our houses falling apart at 44 years and we have places in the UK that are thousands of years old or 1,000 years old and they're okay? Like, do you have any? I did not actually ask you if you could speak to this at all, but I keep wondering about that. Like, what is wrong with us that we're building places that are crapping out at 44 years?
I'm like, there are many areas that we have like they built generations ago. So that's the reason we have this Americans like older like housing stock because they built when manufacturing was very like booming like generations ago. So they built most of their homes like back then, and we see that some of the areas like um, uh, uh, for example Pittsburgh or Buffalo or like Cleveland are some of the metros with the oldest housing stock, which also translates to more like maintenance cost as well, unfortunately. So, and have in mind, like for example, Pittsburgh, all these metro areas, they have built most of their homes before the 1960s. right? So it's like they're pretty old, like homes, most of them. However, when you take a look at the contrast, you have Austin in Texas or Raleigh, the median age, like the most of the homes were built after 2000. So that's a very big like difference, and you can understand like what implications has about like maintenance costs, like how this differs, like in areas where they continued to build like more homes. We don't see that like in this older, like specifically areas like Pittsburgh or like New York as well. New York has like most of their homes like built in early 1960s, or like for example, like Austin, for example, after 2000. So that has many implications, I think, about the maintenance, what like homeowners need to deal with older systems, because yeah, I'm like in New York, some of the homes were built before most of the homes had like air conditioning, for example, and we need air conditioning. Yeah.
Okay, so okay, I'll give it to you. We do need air conditioning. There was no air conditioning in the place that I stayed last summer in
Oh yeah.
England.
Because if you're in
However,
Europe as well.
what?
Because you're in Europe. In Europe, I'm originally from Greece.
Right.
AC not so popular as in the US.
It's funny because I was in Rome a few years ago and it was 96 degrees and 100% humidity, and they had said that our place had air conditioning and they were liars. Humongous liars. And so my big humongous family is going on a trip to Rome, and I keep telling my mom, I'm like, you better hope that these people were not are not lying to you, because my mother will die if there's no air conditioning. She will just that'll be it. She'll be done. So anyway, I hear that, but with that being said, I watch our regulations, our how around housing and the maintenance and the inspections and the input that the cities and counties have into these properties and what is required, and the state in California. We have a lot of requirements at the state level, and I'm wondering, how useful are they when you, again, have a property that was built in 1400 in Europe and it's still standing, and so do we need to change our construction? That's what I keep thinking. Maybe we need to change how we're building houses and have them with a mind that we want them to last longer. It's, my nana always said quality over quantity. You'd better to have one fine item than to have 10 of lesser quality, because it will last and you don't have to replace it. So again, the idea that we think that a house built in the 1960s is old, and in the rest of the world there are houses that have been there for hundreds of years and they're fine. What are we doing wrong here? Like, we're doing something. And Peter made the comment, you want to move into Stonehenge? Very funny, Peter. He also, because he's very busy today, he also had made the comment when we were talking about whether we want the rates to be really low again. He said we knew or should have known that what we earned in the 2 to 3% range was a cash advance in the next several years. Well, no one in the mortgage space, or very few people in the mortgage space, operate that way. I mean, a lot of people forget that we go in cycles. So anyway, so thanks, Peter, for your input. Appreciate it. And then Bill had said, isn't the IRS rule that allows us to exclude the first $500,000 for capital gains, and that's for couples. So for a single person,
Yeah.
it's 250. For a couple, it's 500. And this new proposal on this new bill is proposing they double that and then
Yes.
allow us to adjust for inflation. So thanks for the comments, guys. That's good. Yeah. So yeah, no pointers on how we can improve our quality of housing so it doesn't crap out so quickly.
I mean, we need to adjust some of the rules, but again, it's like state, it's local level. It depends on each
Yeah.
area. As I mentioned, like some of the like in Austin, for example, it's fascinating. I'm like to see so brand new homes, for example, yes, but no, I totally understand. It's depends on how, like, even though you're like in across the US, you have differences of how you build like homes, like in Northeast compared like to West, for example, or the South, depending, of course, like climate, like of course, like the weather over there. So I totally understand. But what we want to have is like more making like the process of building a home like easier. So that's one of the main like what we want to have, like, so we can increase like a little like more supply, of course, there.
Well, what I'm seeing where I am, there isn't a lot of space to build single family homes,
Yeah.
and so they're going up. But what I find is, maybe you want a condo as a starter home, but that's not where you want to end up, and so it's not really helping that much. And I mean, and then what you have is condos downtown that are, millions of dollars. It's like, how's that affordable? Anyway, speaking of builders, NAHB came out with their home builder sentiment for May, and it was better. The National Association of Home Builders, by the way, is NAHB. Kevin usually is the one who's like poking me, going, acronym, what does that mean? Anyway,
Mhm.
so anything under 50 is in contraction, and it went from 34 to 37. So it's improvement, but not great. So current sales expectations went up, 3 points. Future sales went up 3 points. Buyer traffic went up 3 points. 32% of builders cut prices in May versus 36% in the last report. The average price reduction was 6%, up from 5%. And sales incentives were 61%, up from 60%. So, anyway, that new homes market is something that isn't, I mean, there isn't tons of it where I am. So, I don't know a whole lot about it, but you do. Okay, let's talk about retail sales, shall we?
Yes, sure. Yes.
You take it away. Came out for April.
Yeah, so what we see is like retail sales continues to perform like well. And one of the factors that commercial real estate, we also expect, and we see retail commercial real estate to perform relatively like better than most of the other sectors, is because of the retail sales activity. And what we see there is that the, the there's like tight inventory. So commercial real estate retail space is the tightest sector among any other commercial real estate like property. And the reason for that is that because we were not building, we were not adding so much supply. So now even demand is not like significantly like stronger. So it's not stronger from what it was. It's that still like very tight compared the other sectors. So that's the reason we see like fundamentals for retail continues to be strong, and especially for spaces that they are like in locations um, uh, very well located properties, so in very good locations. And we are not, I'm like, what, like the outlook, for example, for retail, like for commercial real estate, is that we expect to continue to perform. Of course, everything is cooling down from what we had like during the pandemic, but retail, for example, is a surprise because of the online shopping, for example. So what we see is that neighborhoods, like neighborhood stores, local stores are performing like better than other like retail shops. But yes, it's good. It continues like to keep to be retail's commercial real estate strong, and it's something that to continue like to watch, I think, for the rest of the year for the retail, specifically like commercial real estate.
Do you think it's going to hang in there based on the inflation that we're seeing and the gas prices and how strapped the average consumer is feeling? Do you think
So
it can
yeah, and
keep
that's
going?
surprising, right? Because I'm like, we also see economic growth. So economy grew about like 2%, right, in the first quarter of 2026. And what we know is that all this time, economy is growing because of the consumer spending. So consumer spending is relatively like continues like to be strong. But what we see is that there are some other two indicators, I think, that can give us an idea about economic growth, about like retail, for example, about how consumer spending will perform. And this is about the consumer confidence and consumer sentiment. And what we see is that both of them, consumers' confidence and consumer sentiment, are still well below where they were before the pandemic. And in the meantime, something else that is also important to see is how these are two moving. And what we actually see is that there is a gap between them. So we had a gap between how they were like, there's a divergence between the consumer confidence and consumer sentiment. And we had that back in 2022 again. So what this means. So let me explain a little bit. So on one side, the consumer confidence measures how people view the broader economy. So things like job availability and business conditions. So it's more tied to what's happening around them. So on the other hand, we have consumer sentiment, which is more personal. So it reflects how people like feel about their own financial situation, like things like their income, their ability to make purchases, and their expectations like for the future. So people feel more stress, and this is what we do. Like we see like with consumer sentiment, like at very low, like moving like downwards, and consumer confidence still move up. Like we had like the latest like release. So that shows that people continue to feel good about the economy. They feel good about job availability, but they feel cautious about their finances. So I think these two indicators shows something that the economy looks better than it feels for many people. So even though they see like, yeah, we have still 150,000, for example, new jobs, right? So economic growth is still good. So they see that, and the consumer confidence reflects that. Yeah, they continue to see economy or jobs to remain like there, but as far as their financial situation, this is where they're like more cautious, and this is where they feel that that we see the consumer sentiment like going down, and something that we need to watch a little bit regarding, as you mentioned, that the cost, like increasing costs, or like the cash, or what happened, like they're affecting like their financial like situation as well. And of course, this is one of the indicators that we also we watch closely as far as home purchases, because people usually purchase a home when they feel secured, when they feel good about their financial situation. So that's another like intuition. They don't feel so good about like the financial situation, but still above the economy. So that's the reason sometimes we see that yes, economic growth has increased, like it's like 2%. The previous, like at the end of 2025, was 0.5. So we have like more, but the consumer sentiment is something that shows that how people like feel about their financial situations. Many of them, they are cautious. And of course, we were talking about like K-shaped economy as well. So this is another like topic, but I speak mostly about how Americans, like the typical American, like feels.
So we read a stat that somewhere between 43 and 47% of people making six figures feel strapped, living paycheck to paycheck. They don't feel like they're doing well. And so for a number of months, retail sales was really being fueled by the upper end, like way upper
Yeah.
end of the economic brackets. Is that still the same now?
We still see that, yes. And the economy, yes. And this is the consumer sentiment can also reflect that as well. I'm like, they don't feel so secured. So it appears that, yes, people at higher income levels can continue like buying and driving like the economy, compared to the middle income, like a buyer, like middle income American, who unfortunately he needs like to deal with like more higher costs, like for example gas or other like for affecting like his current situation.
So you post very prolifically every day, in fact, on LinkedIn. I suggest everyone follow Nadia. Why don't you share some of your favorite posts that you've done?
Sure. And one of the reasons that I started doing that is that because I realized that housing is often like discussed only through headlines. So people hear like mortgage rates are high, home sales are down, or like home sales are up, or prices are expensive. So, but the housing market is so much more complicated than that. So behind like every housing statistic is really a story about people. And this is what fascinates me, like trying to buy the first home, trying to move, trying to build wealth, or simply like trying to afford like monthly payments. And I've always believed that data becomes much more meaningful when you connect it to everyday life. So I started sharing like this short like daily insights to help explain the deeper like stories behind the numbers in a way that feels like practical and more relatable like for most people. So for example, like today, I posted something about the income needed for a starter home. And so what we see is that a starter home, like it was about like the income needed to buy a starter home like today is not a starter income. So I think this is something what we need to have like in mind, because in many metro areas like today, buying a starter home requires a six-figure, more than a six-figure figure like income. So, and that really shows how much the housing market has changed like over the last several years. What's important is that starter homes still exist. The issue is affordability, and we continue to see that. So these the entry level homes, the even though like we define as entry level homes at 85% below the median price, we don't see that. For example, the starter home in San Jose is like about like $420,000. So that's not a starter income, I will say. So that was fascinating. I have a map like with the income needed like for a starter home, and it's
Oh,
fascinating.
the income needed for a
Income,
starter home in San Jose was 420,000.
yes,
Okay,
yes,
that makes more sense. Okay,
yes,
that I've
yes.
only
No, no,
I
the
wasn't.
starter income, no, the starter home.
Yes,
The
yes. I'm like,
price,
yes. Okay, great.
it's
Wow,
almost like 2 million. So that's the thing. I'm like, because usually it's 85% like below the median price. But yes, the starter income. But for many people that they start like professionally, that's not their starter income. That's, I think, a very good like point to have that because before a starter income could support like a starter home. Then something else like on that note, another day I had like about the rise of the 1 million homeowners. For example, a decade ago, like owning $1 million like home was relatively like rare, and mostly in concentrated mostly in few luxury like coastal markets. So today the share of homeowners living in homes worth like over 1 million has increased like to almost like 8% from 2% that it was
wow.
like in 2005. And that what's interesting is that this isn't just a luxury market story anymore. So in many markets, ordinary, I would say, middle class like homeowners became $1 million homeowners, right? And we see that simply because of long-term appreciation as well, because that's the main reason that we have it. So especially markets like California and parts of the Northeast, like South Florida, we see that. So that was something else that I wrote like very recently, or for example, like then how much more homeowners earn than renters. So that's something else that can reflect why for many renters it's so hard to transition to homeownership, for example, because when they don't earn the income that they usually need in order to buy the neither the starter home, so that makes it like even like harder like to do the transition. And of course when you take a look at local level, I think this is very fascinating. And also something that we don't discuss like so much is about like renters are feeling locked in too. So we spoke like before that homeowners are locked in, but and we talk often about that, but renters are increasingly experiencing like their own version of lock-in. So they are staying longer because um, higher rates, elevated rates make like buying like harder. So higher rents make saving harder, and home prices remain like elevated. So many renters feel stuck between
Yeah.
like rising rents and affordable like, home ownership like cost. And specifically, even though it doesn't look like from 5.6 to 6.5 in a decade, the median how many years they stay like in their homes as renters, maybe it doesn't make a big difference, but when you think about millions of people like staying there, then you realize how yes that makes it like for more people like stay longer over there. Then these are some examples. I think yes, it's like every day is like how I wake up in the morning. Whatever is like it's very interesting to me. And what I have to say is that we may have like a shortage of homes. We have a housing shortage, but we don't have a shortage of data. So we have like plenty of data out there, and that's very fascinating. And every time, whenever I find something that it's interesting to me, I'm like I can work on that like for long. I'm like honestly, I just want to see what it's gonna show. Yes, it's very
Yeah,
fascinating.
that's great. Well, follow Nadia on LinkedIn, listen to her or read her insights daily. And next week, we're going to take a little dive into the differences in those scoring models that we keep talking about on the credit scores. So, with that, guys, there's a lot of loans out there. They're not so hard, they're not so easy, but when they're harder, there's less competition for that loan. So, go get a loan, fund it, and we'll see you next week. Thank you so much, Nadia, for being here. I really, really appreciate you. Have a
Thank
great
you,
week,
Audrey.
everyone.
Bye.
Bye.